So welcome to the webinar. Hopefully everybody can hear me. Thanks for joining. I know we're getting started about a minute early. So we'll get going here in 1 second. First of all, I want to thank everybody for their time on this afternoon. It's an honor to talk to you all, and we really appreciate your interest in what we have to say. A lot of news has gone out, and I'll go through the slides since we have about a minute before we have the actual time to kind of go through and talk a little bit about what's going on in the muni market and talk a little bit about what's happening with what is going on with the Biden campaign as well. The overall thought process of the webinar is just to kind of cover a little bit about taxes, about the stimulus package that came through, 1.9 trillion. Obviously, the president is going to talk about and try to get together another 2.25 to maybe 3 trillion over the next 8 years. So there's a lot of things going on in the muni market that are responding to that. So we're DRL Group. We specialize in primarily high-grade securities, some corporates, tax deferred accounts. I've been doing this since 1994, and we have the way the firm is built is we have 5 traders that specialize in various asset classes, 2 other traders that specialize in various locations of the country and asset classes, and then my brother and I handle a lot of the retail accounts along with Logan Blewett. So that's kind of the makeup of our firm. That's our information right there, as you can see. That slide right there is for the legal folks in the room. I know we have a few of them in there, so just want to kind of get that slide out of the way. A lot of people ask us as far as why we want to buy munis. I mean, why are we buying municipals in what appears to be a rate environment that continues to move up? I haven't really looked at the 10-year lately, but I think it's around a 171 to a 174. And that's up significantly from, 1% not terribly long ago. And a lot of people are very concerned about inflation and government spending and, what's going to happen as far as obviously the pandemic. Yields definitely have moved up for sure. The overall supply pressures to the new issue market continue to remain high, and we'll get into that in a second. We feel, along with a lot of banks that we deal with, feel that a lot of asset classes out there are overpriced due to the fact, particularly when you get into private equity, everything is so yieldy and lack of yield for high-grade securities that if a private equity transaction is yielding 8, it maybe should really yield 10. We have a lot of accounts that trade private equity. Obviously, that's not something we do. However, we would caution going against any private equity and make sure that the fundamentals are sound because everything seems to be overpriced. Overpriced meaning that the yields are low and prices are high, obviously. It's evident to us and probably to all of you guys that the municipal markets are the safest, some of the safest in the world. If you put them up against treasuries, we've seen 2008 through 2010 bailouts when they restructured a lot of the insurance companies. And then we've also seen, of course, the Mnuchin plan that put together a overall package to allow Main Street lending to access the liquidity, what they called the liquidity facility. And they bailed out municipals based upon the fact that they wanted to not have any type of major, massive defaults, similar to what Meredith Whitney predicted in 60 Minutes probably 15 years ago, if you guys remember that. We recommend a large portion of your net worth in municipal bonds. The average that we find is anywhere between 45 to 60% of the investable assets are in high-grade securities. Most of our clients look to put that type of asset money in that allocation. They are concerned about the equities of the world, mutual funds, private equity. They do obviously buy that product, but for the most part, they rely upon us to manage their municipal debt. Going long munis in this market, why would you do that? That kind of goes back to what I was talking about earlier. The right level, the resistance point on the 10-year treasury seems to be a 175. You can pull it up on a chart and you'll see where the resistance level hits a 175, it comes back, it hits it again, it comes back. That has happened a couple of times now. There's large money that is buying high-grade securities in this market at this moment. Large money meaning the mutual funds of the world, the vanguards of the world, Nuveen's, and so on and so forth. So we are seeing a lot of money movement from equities into high-grade securities. Dealer inventories are extremely low. I have a slide, a couple slides down, that will discuss and show dealer inventories, and they are very, very low. Dealers simply don't have the incentive to sell securities below the offering price that they're offering. You, in some cases, can get securities lower than the offer price, but there is real no incentive because everything's being sucked up by retail and by the vanguards and by the mutual funds of the world. Issuance for 2021, we'll talk a little bit about that. It's going to be lower, and for the simple reason that this $1.9 trillion deal, $550 billion of that is going to go to states and municipalities. Out of that $550 billion, the states and municipalities are going to use that money for infrastructure build out, hotel occupancy tax, tourism. Wisconsin just published a breakdown of what they're going to be using for, they're getting roughly $17 billion. They're going to use $200 million to $500 million of that for infrastructure build out. My point is that normally would have been a municipal bond or 2 or 3 or 4. But since there's so much money coming into the system through this last stimulus package, 1.9 trillion, 550 going to the municipalities and states, they don't need to go to the primary market. So expect issuance to be relatively pretty low as we go through 2021 for sure. And obviously we all know that Yellen and Powell are going to keep rates at 0. That's a pretty common knowledge. There's really no debate about that at this moment. I've got a dot plot coming up that'll show that and it'll prove that, and there is no talk about raising rates. The fundamentals of municipals, if you're looking for safety, look very, very strong in 2021 through 2022 for sure. As we mentioned, $550 billion of this package is going to go to the local governments. That's going to create the low supply that we've already discussed. Tax rates, obviously, they're going to have to pay for these stimulus packages somehow. I don't know how. I suspect they're going to pay for them through taxes. And obviously, they've already indicated, they meaning the government, corporate income taxes, personal income taxes, cap gains, LLCs, 1031 exchanges, any type of tax that they can get on any type of security or asset or transaction they're going to look at. We do not believe, along with most of the broker dealers and all of the banks, that they will not put a cap on municipal interest. There has been talk about capping municipal interest such that if you have X dollars greater than, say, $250,000 in interest from municipal bonds, then your tax rate on those greater than 250,000 would be a slight percentage of your overall tax rate. I doubt very seriously that that's going to happen. They've discussed that in the past during the Obama administration. It didn't get any traction, and I don't think it'll get any traction in the Biden administration as well. High-grade munis maintained almost a zero default rate. There was one high-grade muni that had some issues. The insurance kicked in, but for the most part, all high-grade munis maintain a very, very, very low default rate through the pandemic. And that's something that we really are glad to be in this market as opposed to others as well. And then credit definitely will benefit from what they're calling the American Rescue Plan. That's the monies that are going to go to the municipalities. And the states will definitely welcome that money. As you see there, that's a graph from Bloomberg. It's a jobs loss. And most states, as everyone knows on this call, have had problems. I'm sitting in Houston, Texas, and we're coming back. Texas is definitely coming back. We opened up in May of last year. We lowered the vaccine date or age to 16, and people are starting to kind of get through the vaccinations, and that's going to happen through the states. But the states definitely need this economic boost in order to get their things going again. And again, most of that's going to go to tourism and to stadiums and to parking garages, tollways, hospitals, stuff that was pretty well hit by COVID, which is going to be a nice overall deal. The overall T-bills moving up on stimulus, I've got one person saying they don't see the slides, so I want to make sure you see the slides for sure, to make sure that they can see. So I want to be sure that you can see. And this program, by the way, will be on our website tomorrow after we upload it. So you'll be able to see the slides as well. The T-bills moving up from the standpoint of what's going on. Obviously, treasuries, as we discussed, treasuries have definitely moved up. They've been the highest since 2019 for the 30-year and for the 10-year since February of 2020. So from that standpoint, the overall thought process is that the yields on treasuries will continue to move up. Let me see if I can. Charles Bates came in and said that they cannot see the slides. So hold on one second. How about that? That's probably better. So T-bills are moving up. Let me move this over a little bit. And there you go. So you can hopefully see the slide now. Yeah, thank you. Thank you, Pat. I appreciate that very much. So backing up just a little bit, just to give you a state's welcome, that's the jobs from the states itself. That was slide number 6. So luckily we just started, and that's fundamentally munis look strong. So we can kind of go from there and take it from there. So thanks a lot, guys, for letting me know about that. So that's T-bills from moving up from the stimulus package itself. So as you can see from that slide, which everybody now can see, the 10 and the 30-year, we're pretty much the highest since 2019 and the highest since February of 2020. So we're definitely buyers in this overall market. The interesting thing about it is that I did a kind of a comparison. If everyone on the call remembers the taper tantrum, those graphs, many economists believe that obviously the rates that we're experiencing now are from higher growth expectations. And so therefore, I went back and looked at 2013 when they did the taper tantrum, and it was kind of interesting where it was a monetary policy shock in 2013 where it was premature tightening, which everybody remembers taper tantrum, and it was like, oh my gosh, nobody got any type of warning whatsoever. And now we see demand shock. So it's kind of it's not really the same result, but it's producing the same type of a result from two separate entities. One is, hey, we're going to produce, GDP is going to move up, we're going to have a lot of jobs, demand shock is going to be good, versus monetary policy shock where the Fed and Treasury came out immediately and said, okay, great, we're going to start tapering, and all of a sudden everybody was shocked. And we firmly believe that that is not going to happen, along with all broker dealers, most economists. The Fed and the Treasury learned their lesson from the taper shock. So we don't really see that happening. We're going to get plenty of notification for that. We are buyers in this yield. You can see there that that is a 25-year index for muni bonds, and you'll see we're on the far right, that recent rise in yields. And the reason we've seen that rise is because dealers like us were prepared to accept these treasuries in the open market. This $1.9 trillion deal, Biden had to raise capital. And in order to raise capital, they had to sell securities. In order to sell securities, they had to go to the auctions. And we participate in the auctions through auctions for large corporations and banks. And dealers like us were lowering bids. And consequently, the treasury markets faded meaning went down in price, up in yield. Munis went along with that. So in sympathy, even though fundamentally munis should be strong, fundamentally also munis went up in yield, down in price. There's not been very many buying opportunities to buy munis at these levels. One of the reasons why, as I've discussed before, is inflation fears continuing to be high. Inflation by Yellen and Powell, they've indicated that they will keep inflation in check. 2 point, and I've got a slide coming up talking about under 2.3%. The climb in yields definitely is based upon Fed rates, policy, Fed stance, et cetera. But overall, with municipalities issuing less bonds, with heavy cash balances and money market accounts currently, with more to come, with taxes going up, we still feel that munis going through the rest of the year are going to be strong, both fundamentally and technically. Stocks, they're going to be tethered to rates. I mean, bank stocks right now are doing well, obviously, because of rates moving up. But as you can see with the NASDAQ and Dow, specifically the NASDAQ, as rates went up, you saw some selling pressure. And obviously, we remain buyers in this market. Elizabeth Warren, which all of you know, as of 2/2, she's going to join the Senate Finance Committee. And no matter what your political orientation is, I think we can all agree that she's going to look at raising tax on both all of us on this call and all of the overall thought going into trade in healthcare. She's going to definitely influence overall trade. She's going to definitely influence her constituents, and she's going to definitely influence Biden. We think that as taxes move up, along with other things that are going to impact munis, the taxable equivalent yield will continue to move up as well. So when you're looking at munis and talking to your broker and determining overall how you're going to evaluate munis, don't just look at what the yield is, convert it to your taxable equivalent yield as well, and kind of have an idea as to what that overall thought process is when you're making those decisions, for sure. For taxes, I mean, we've already know that the 3 stimulus packages have been passed, $3 trillion in total, $550 billion, which we've already discussed. Debt service for T-bills will go up. Obviously, the Fed is going to continue to keep yields as low as they possibly can. And they're going to continue to have to raise money, particularly if this $2 trillion, $3 trillion deal gets passed, which I'm sure it will be over the next 8 years that Biden is speaking about today. Taxable equivalent yields, as we discussed, we believe, along with others, that the troubled states, New Jersey, New York, California, Illinois, those type of states, Puerto Rico, which is a commonwealth, obviously, they will get help, federal help for overall Biden administration assistance. So it is really a thought process on who's going to get this money. California, they've already indicated it's going to receive $23 billion. So there you go. I mean, that's just going to happen. Biden obviously has indicated that there is going to be a corporate income tax rate raised from 21 to 28. They're looking at LLCs and partnerships. Obviously, he's already said through his campaign that he's going to raise individual income tax earnings for individuals making more than $400,000. The street overall, muni bond dealers like us and our colleagues in our overall bidding process, in economic forums, we all believe that that's probably going to be down to 250,000 when it's all said and done. Cap gains taxes, that's going to be interesting whether or not they make that retroactive or not. But that is definitely going to impact the equity markets from that standpoint. That graph is a U.S. federal budget yearly total receipt, and it's going to be hard to see probably on your computer. The first red line is Reagan tax cuts. The second is the dot-com bust, and the third is the credit crisis in 08 and 09, and then the last one on the far right is the Trump tax cuts. So as you can see, overall federal budget yearly going through, the receipts itself have gone down. Taxes will be raised, and budget deficits will probably continue, obviously, to go up. Another item on taxes, while we're on taxes from the Biden administration, he's already indicated that he's going to investigate eliminating the step-up basis of death. That's a big, big issue, and that will affect many, if not, that will actually affect everybody on this call, but it'll unfortunately be a very big hit to some estates if that is addressed and changed. Obviously, cap gains taxes, he's already indicated that. 3.5 million proposed exempt estate tax is what he's proposing, and the current applicable tax rate for estate GST is 40%. He's proposing to raise it to 45%. The reason I'm spending time on taxes is because most of our buyers, just not ours, but most of the muni bond buyers, they're looking at this as an opportunity to buy quality assets that are insured that will protect them or to insulate them from an overall tax hike. Not saying to buy not to buy equities or private equity or anything like that, but taxes are a big part of what's going on in our world right now, particularly now with all of these stimulus packages and as with the new administration coming into the White House. The Fed, Powell, and as you know, Yellen, they work together, of course. Powell has indicated that they still see sizable downward risk in the medium term. So they're not interested in raising rates. I mean, no one out there is really interested in doing anything with rates, quite frankly. And they have stressed as recently as the last meeting, there's productivity growth continues to be sluggish. Many believe that there won't be a rate hike until 2025. That's a little bit long for us. I don't like to really predict that far out. Obviously, we feel fairly confident that there won't be a rate hike through 2022. Inflation expectations, everybody, that's the hot topic along with taxes right now. When we talk to our clients, and I'm sure when you talk to your brokers, inflation is the hot topic. It has been muted from the standpoint of most of the Fed, Treasury, and everyone else in the street. They don't really believe that we're going to see tons of inflation. The Fed has indicated that they will keep inflation under control, and Yellen specifically has said that there's many tools in the toolbox to keep inflation under that 2.5 or so percent. I don't really know exactly what tools she's talking about other than purchasing securities, and they're going to continue to purchase securities to keep that inflation down. We personally believe that we'll probably see a little bit of inflation, but it will not be anything significant to where it's going to deteriorate or erode returns on munis for sure. So we think it's going to hold steady through 2022. As everyone knows, most likely on this call, that Janet Yellen is known in the industry as the super dove, keeping rates low through her term. And she's already indicated that multiple times when she was nominated. She mentioned many times that her overall objective is tax and spend, and not really in that order and not really those words, but that's really what she wants to do. And she's going to keep rates low in order to do that. They definitely have history together, and they both believe in government stimulus. They've worked together before in the Obama administration, obviously at the first of the Trump administration, and both of them believe keeping rates low. That's going to be good for munis over a period of time as munis continue to go through the system, low inflation, government stimulus, high taxes. You should have a pretty good runway for the next couple of years for sure. Many, as I said, predict 2022 will be rate steady. The real question is that what's the right bond to purchase? When's the right bond? What is the timing? So on and so forth. We're buyers all the way through, and we buy through good times and bad, but we don't really try to time the market, although yields now are most likely up, depending upon the bond, 20 to 30 bips from where they were, say, 30 days to 45 days ago. So we're definitely buyers in this market. That is the Fed to the rescue chart. So to put it in perspective, we spoke about the stimulus package that came through 2008 and 9, which is on the far left. That's $880 billion that was pumped into the economy back when the economy was struggling in 08 and 09. To the right, that's $3 trillion pumped into the economy. And as you can see, it continues to move up. So to put it in, that's a good perspective to look at exactly how much money has been pumped into the system due to COVID and getting the economy back on track. That's the dot plot that we discussed earlier. And that dot plot was taken just a little while ago. And the issue really is that no one believes that anything will change with monetary policy, Fed fund rates, or any type of interest rate changes through 2023. So that dot plot takes you to 2024. Dot plot is a mechanism, or is a graph that we use to try to understand what the Fed is thinking. And it's thinking that it's not going to move rates. Inflation predictions, hot topic, taxes and inflation. This takes you out. This is a graph that talks about the 1, 3, and 5-year averages of inflation. As you can see, the dotted line, of course, is 2%. Down at the bottom, it takes you all the way out to 2024, 2027, all the way to the right. So that kind of gives you an idea of what most folks are thinking out there from the standpoint of Fed policy, dealers, inventories, and banks. So that kind of gives you an idea from inflation predictions. A lot of our clients ask us about various states. We trade across the country, although obviously we look at a heat map. As you can see, California, bright green on the far left, of course, that's upgrades. So those are upgrades and downgrades. Of course, New York have been downgraded due to the fact that, unfortunately, with COVID, a lot of people moved out of New York. They continue to tax their residents. People are a little concerned about what's going on in the state and the city, for that matter. But we use these graphs, and your dealers out there use these graphs to make decisions on where to bid, what to bid, how to bid, whether it be aggressive or not. And quite frankly, California has done very well over the last 3 years. They've been upgraded a couple of times, and they continue to be on the positive side. They've collected a lot more revenue than what they thought. Conversely, a lot of the other states, for example, Oklahoma, where they have not done so well. COVID hit them very, very hard. It's a very rural state. So those are the things that when you're buying bonds to look out for, to have a better idea as to the overall state, not only demographics, but how they're looking from an S&P and Moody's standpoint as well. I pulled this slide up only because of the fact that Citi is fairly well respected in our industry from an underwriter standpoint. Citi, Bank of America, they're one of the two top underwriters, and we deal a lot with them. They called for heavy issuance in 2021 early on, and this has not happened at all, actually. They have weekly, they were thinking 550 billion. They're now thinking roughly 515 billion. 550 billion of that is going to be offset by stimulus. So you do the math and say, okay, well, if there's $550 billion coming into the states and municipalities, obviously all of that's not going to go to infrastructure build out, of course, but let's just say half of it's going to go to infrastructure build out, which is probably a pretty good number. So this goes back to how much infrastructure build out will be done in what we call the primary market, the underwriting market. As you can see in 2020, October 26, 2020, it was 384 billion. And then everybody came to market at the end of 2020, knowing that we were going to have a change or perhaps a change in administration. So all of 2020 was 480 billion. We believe obviously that forecasts are a little heavy, and we're calling for in the 400 to 450 billion range. A lot of people are calling for that, which is going to really put a overall contraction on the municipal bond market itself. Many are not expecting a full recovery in issuance through the end of 2023. This money that they're receiving or going to get, they're going to use this money sparingly, and they're going to be very selective as to what they're going to need to go to the primary markets for. So that's very, very important to know. That's a graph, basically what we just discussed. That's issuance. So we look at that as dealers and find out how much stuff is coming to market. So pre-elections, obviously, you look at October, which I realize is hard to see on that horizontal axis, but in October, there was a huge amount of issuance, obviously, because you had uncertainty coming into the market. So everybody and their brother came and tried to get bonds done, which they did, by the way. Obviously, it tailed off, which it normally does at the end of the year in December. That's that big V. But look at it now. Look at it all the way over to the far right. Look how that chart is just nosediving down. That's going to continue. So finding paper out there, due to the fact that this primary market is struggling to issue paper, it's going to continue to be hard. Why we look at mutual funds, they are a big source of product for us. We provide them, and most dealers out there provide them liquidity. They give us insight on what's going on in the world. When Meredith Whitney came out and she said on 60 Minutes that everything was going, I think she said 15 billion in defaults or something stupid like that. Mutual funds sold bonds as fast as they could because everybody was selling their positions. The issue with mutual funds, and I'm sure everybody on this call, knows about them, owns them, or has traded them before, is that you're at the mercy of others at that point. And we really like that as a dealer. We like that due to the fact that we're able to buy cheap product when everybody else is panicking. So we see how those outflows and inflows happen. And it gives us a very, very great way to see what's happening from a credit quality standpoint and from a fund flow standpoint. That's mutual fund inflows and outflows. Obviously, those two lines on the left, those are outflows, of course. That was, of course, COVID. So you saw a lot of outflows coming in, and then obviously it somewhat stabilized itself from May on. We had a small outflow a couple of months ago, and then we're starting to see inflows again. We track this very, very closely to have a pretty good idea as the direction of the market itself. And most dealers do this. And the way it works is mutual funds will come in and ask for product bids based upon either the state or the credit quality or the individual municipality. And they'll come in to dealers such as us and ask for liquidity markets, which is effectively a fancy word of saying they need a price on bonds. So that's how we do that. And as you can see, and that graph has a lot of different colors and variations on it, but fund flows have very, very big impact on yield. So as you can see, as fund flows go down, which is the white line, then yields obviously spike up. So that last white line going down, and it's kind of hard to see on the far right, but you see where those yields spiked up. So, as fund flows go down, you'll see yields spike up and vice versa. So that's a graph that most dealers use to see that. When you're buying mutual funds, by the way, make sure that you buy mutual funds that are unleveraged and you know exactly what you're buying. Unfortunately, when mutual funds buy and sell securities, they usually buy and sell securities of all different types of credit qualities. And when they need to raise liquidity, they usually try to sell off the best stuff there is. That doesn't necessarily mean credit quality. That means what they can get the best price for. And if any of you guys joined us on our last webinar where we spoke about the COVID trade, most mutual funds had to sell off their high grade stuff because there simply wasn't a bid for low grade securities during March, April of last year. So sadly, what ended up happening is that a lot of the high grade product was sold, and a lot of the triple B rated, single A rated, questionable product, healthcare, CCRCs, which are continuing care retirement centers, stuff like that, were left in the fund. So be aware of what you own. That's just a word from us. We're heavy in insured product. Insurance continues to be very popular. A lot of dealers out there, like us and others, bid on pretty much anything that's insured by AGM, AGC, BAM, Berkshire Hathaway, and now there's another one called BAC, B-A-C. S&P has reaffirmed BAM and AGC as of July of last year, post-COVID. They usually look at them in the summer. I suspect that they will reaffirm them in June or July of 2021. BAM has been continually underwriting business in a much quicker pace as opposed to Assured. and BAM is really making a big market in the insured product. At this moment, from what I understand, BAM has no municipalities in default. BAM is not exposed to Puerto Rico. They are exposed to Chicago and they are exposed to Illinois, but they are not exposed to Puerto Rico. Assured, on the other hand, is exposed to Puerto Rico. Obviously, if you own Puerto Rico debt and if you own assured debt, you know that you're being paid. But of course, the underlying credit quality of Puerto Rico is either in default or triple C due to the fact that the credit quality is not up to par by S&P and Moody's. We are Puerto Rico buyers for the assured flavor, and we are not buyers of any others due to the fact that that's really just not our market. So we continue to remain buyers of insured paper for that reason. I spoke about dealer inventories on maybe the third or fourth slide, and that kind of gives you an idea. So when you come in and you try to buy bonds, just know that overall dealer inventories have been trending lower. There's not a lot of product out there to buy, and unfortunately, and that's I wish there was better news than that. I wish that was something that we would be able to say that there's product galore and we can buy as much as we can and we can sell as much as we want. But the reality is that that's not the case. And as you can see by this slide, that's obviously not the case. Overall, dealer inventories are at historic lows. At least I've been doing this since 1994, and they're at historic lows from that standpoint for sure. No one really wants to go long paper unless they can sell it to their retail. Very few dealers out there are what's called prop traders. They don't buy paper and try to flip it to another dealer. Most dealers have their own retail sales force, and they sell those bonds to the retail. So once a dealer acquires paper, it very rarely goes back out onto the street because they have to satisfy their own retail. So that's something that's becoming more and more of an issue in our markets for sure. We look at bid flow as well, and that kind of goes back to that mutual fund slide where we're looking at bid flow and saying how much is out for the bid. And effectively, all that really means is what's the par value looking for a price? You as a bond buyer want to sell $100,000 worth of Midland, Texas bonds. You need to get a price from your broker. Well, that's $100,000 worth of par value looking for a price. So that graph right there shows you bid flow. Obviously, the center of the graph is COVID. That was a very unusual time. But if you strike that, you'll see bid flow is relatively pretty steady, maybe slightly down over time. But, bid flow is really what we live off of. The reality from a dealer's perspective, however, is that you might bid on 1,000 items during the day. And our average hit rate, just to give you an idea, is anywhere between 12% to 13% to maybe on a good day, 15%, meaning that everything, if we bid 100 items, we would be buying 15 to 12 items, 15 to 12 QSIPs. We're currently running at about 7 to maybe 9%. And that's just not us. That's the dealer community in general. So unfortunately, we're spending a lot of energy trying to purchase securities, although those securities are not coming for sale, whether the other side of the trade is going to cross them internally, but they need a price to go off of due to FINRA regulations, or they're simply evaluating the price or reflecting that price back to the customer and the customer is not selling. What that's really telling you, though, is the underlying message to that is that customers are not interested in selling. Even though rates have gone up, even though this whole inflation and taxes have been discussed, and even though we've had a change in the administration and all these things we've discussed in the past slides, at the end of the day, there's not very many sellers. There's heavy buyers, but there's not very many sellers. So that tells you something, that the municipal bond market continues to be a firm, steady, liquid market. And it's very difficult for us, and talk to your dealer, talk to your broker and quiz them and get their feedback, because that's something that we're definitely seeing. And I sit on, as I said, panels once a quarter, both an economic panel and a dealer panel. We represent what's called the regional broker dealer, and we represent dealers regionally. And this is what we're hearing from other dealers nationally. So it is not just us, it's across the board. Bid flow really matters, going back to that overall chart. I mean, it definitely creates volatility. No matter what you think or say or believe or want to believe, volatility is definitely our friend. It's a dealer's friend. And I mean, that's the facts are the facts. The volatility generates a trade. The trade generates the client. The client is happy due to the yield. And that's really what we need. And that usually generates a good trade for the client because volatility generates sell on the week. And we go ahead and scoop those up and then sell them off to a retail client or to one of our institutional accounts. Overall, historically, the municipal market, as all of you have seen, that buy bonds bounce back much, much quicker than a lot of the other asset classes. And if you're buying good quality product, you really never had anything to worry about. I know it's easy said now on March 31st, when we look back March of 2020, you know, who would have thought what would happen? And we can all be honest with ourselves and say we didn't know what was going on at that time. But looking back and reflecting on that, I think we can all agree that, you know, if you're buying quality product, that quality product is back to where it was, or if not higher than where it was. So definitely it's important to keep that in mind when you're buying bonds. And then you might hear sloppy market or efficient market. That's a terminology we use from a dealer community, and we talk to our clients. We really like a sloppy market. I know that sounds really kind of bad, but from a sloppy market standpoint, that generates a wide spread. When you have a wide spread, you can actually buy bonds cheap, and you're able to get them to your overall customer cheaper. So getting something from a sloppy market versus an efficient market is something that we're really trying to achieve. A typical transaction is this transaction. The street goes to the trading desk. Let's just call it Merrill Lynch. The trading desk is entitled to a markup. No one wants to work for free. And the trading desk is putting out capital to purchase securities on behalf of the firm capital. So they're entitled to something. There's nothing wrong with that. The broker then in turn sells the bonds to the client. The broker is entitled to that markup as well. So therefore, you're seeing a trading desk markup and a broker markup. Nothing wrong with that. I'm not suggesting that's bad, good, or indifferent, but that's a typical transaction. And lastly, from our transaction chain, we are the dealer. We are the dealer facing the street. We have no broker. So from our standpoint, we're purchasing bonds from the street. We're purchasing bonds directly from the seller. So that would be, say, Merrill Lynch as an example. And then we in turn internalize those bonds in our inventory. And then we take those bonds to various retail customer accounts with a small markup in the inventory account. So what we hope that generates is enhanced pricing for the retail customer and overall thoughts going through to say, okay, fine, we can pull overall yields. And my last slide is really who we are. I mean, I think it's pretty evident. We specialize in the bond market, primarily high grade stuff. We are really not an equity shop, a mutual fund shop, a private equity shop. We're really just a fixed income shop. We really only take care of clients that look to us to manage their fixed income portfolios. That's what we do. That's all we do, and that's what we've done. We really try to do customer service from the standpoint of making sure that we fulfill the obligations to the customer. The last thing I'll talk about is very quickly the reality to what's going on in this $1.9 trillion deal is that you have three issues that we've covered. You have taxes, you have lack of supply, and you have fundamental things that are happening with municipalities, all of which are going to be good for the municipal market, all of which should create value in this overall asset class. And with Biden continuing to pump money into the system, we can debate all day long about will rates go up, down, sideways, or will inflation go up? I'm not here to really debate that. What we are discussing is how that's going to impact the credit quality of the asset class. And the credit quality of the asset class, Moody's put out a piece, which y'all can Google, speaks about that they view this as positive. They view this as a good quality injection of capital. I'm not suggesting I agree with the capital injections, because all of us on this call will be paying much higher taxes, and unfortunately other things that might be impacted by your loved ones, like the gift tax or the estate tax or any combination of the both. But at the end of the day, we look back on yields and say there's been very few buying opportunities. Meredith Whitney, 9/11, 2008, 9 and 10, the taper tantrum, obviously COVID. There's been very few buying. Orange County in 1994, when they filed bankruptcy, there's been very few buying opportunities. And so we look at this as saying this is an opportunity. We don't know, quite honestly. I'm not going to pretend that we have a crystal ball, and no one should really tell you where interest rates are going to go, because at the end of the day, it's really anybody's guess, so to speak. We can only base upon what we've heard and what we read. But what I'm trying to say is that, from the standpoint of rates and inflation and credit quality, things should continue to improve through the next 12 months for sure. If there's any questions, feel free to email me. As far as my email was on the first slide, I can go back to that slide, since I'm sorry that was not showing. But please email any questions, any thoughts, any comments. I've been honored to take up 45 minutes of your time, and on a March 31st at the end of the quarter. We feel overall that munis continue to perform, and I would connect with your broker and try to purchase securities as cheap as you possibly can. That's the first slide that you guys didn't see. That's who I am. That's our telephone number, and that's my email. Feel free to email me direct, and I'll be sure to respond to you. So in that, I appreciate, I'm honored to talk to all you people, all you investors. I'm really glad that we had this opportunity to spend time together, and please be in touch if there is any other questions one way or the other. I'm going to end the meeting, and we'll put this on our website. So I really appreciate the time and the attention and your interest in what we do. Have a great day.